Welcome back. I wanted to do a video updating all my stock buys and sells for June and July of 2026. So here it is. I'll go over each move that I made and give a quick version of my thinking in regard to each move. As always, none of this is financial advice, but I hope you enjoy the video. I've set my spreadsheet up here so you see the company, the ticker, whether the move was a new buy, an add, or a reduce, or an elimination of the position. And you'll also see the dates that I either bought or sold the stock and how much I'm currently up or down on each stock on a realized basis over here or an unrealized basis without any consideration of dividends. And as you'll also see, there are multiple accounts that I buy and sell stocks from. So I do list the gains or losses as being in account one, two, or three, but the dates of the buys or sells don't necessarily align with the particular account. The unrealized gains or losses you see are based on the closing price from Friday, July 31st, 2026. The first stock I bought in June was Dexcom, ticker symbol DXCM. I've done two videos on Dexcom stock recently on the channel, so make sure you check those out if you haven't yet. In short, Dexcom makes continuous glucose monitors and provides software that goes with them so people can continuously monitor their blood sugar numbers throughout the day. Dexcom stock has been beaten down for different reasons, among them the thought that GLP-1s would negatively affect their business. But actually, as I explained in those prior videos, Dexcom is taking steps to expand the total addressable market for their products. So that is a catalyst. And I saw what looked to be momentum on the chart and thought that it could break out of the range that it had been in for a while, which you can see it may be doing that here after the recent earnings report. Valuation wise, I thought the stock looked like growth at a reasonable price with double-digit revenue growth expected in what I thought was a reasonable multiple on the stock. So I started buying it on June 1st, and then I bought it again in June and a third time in July. And as you can see, as of the close on Friday, July 31st, the shares in account one are up 13.7%, shares in account two are up 16.09%, and the shares in account three are up 14.31%. I do think that when you look at the trajectory of the business and the stock chart, there's more upside here. And there is a gap on the chart that would fill at $107.56. The second stock I bought over this time period is Zoom Communications, ticker symbol ZM. This was a new buy. This isn't a massive position or anything, but I like that they are still growing revenue. As enterprises have Zoom rooms in their office spaces, and Zoom has over $7.5 billion in net cash on the balance sheet. If we look at the chart, while the stock sold off after COVID, it's generally had more positive momentum recently. They also have a stake in Anthropic, which is the AI company that develops Claude. My shares of Zoom are up 2.62% so far as of Friday's close. The third stock I bought was Coupang. I already owned this one, but I added some to account three in June. I've also done videos on this stock in the past, but basically Coupang is a South Korean online retailer that offers fast delivery on products, and they're also looking to grow in other ways, like becoming a cloud provider. They've also expanded into Taiwan. Some compare them to Amazon, and while they don't have the AWS presence of Amazon, they're similar in some respects. Their margins might never be as good as Amazon, but I do like the mode of the company and the physical infrastructure that they've built out. And despite some recent struggles like a warehouse fire and a data breach, I think the company will be durable in the long run. If you'd like more information about this company, feel free to watch some of my past videos on Coupang. I am down on this one right now, but I'm fine continuing to own the stock and might even add to it once the chart shows some more positive momentum. The fourth stock I bought during this time period was Block Inc., ticker symbol XYZ. I've owned this stock for a while, but added to it. I still like the company's longer term growth potential. So I don't like it when people lose their jobs, but I do like that Block seems more focused on operational efficiency. The balance sheet is solid with less than $1 billion in net debt. The stock trades at less than 2x sales, and the stock is showing some positive momentum on the chart. If we look at the chart, it's been range bound since 2022, and I think if it breaks out of this range, it could do so aggressively. Many payment stocks in general have not been in favor, and I'm betting that the market will eventually see them as better opportunities. Right now, we're up a little bit on the stock in two accounts, but as I've alluded to, I'm looking for this one to break out of this range eventually. Yet another stock that I've bought since the beginning of June is Kraft Heinz, ticker symbol KHC. I owned this one in the past, but I sold it all in 2024. They still have debt, which they've been paying down, and I still have some concerns about the amount of goodwill on their balance sheet. But I thought with the free cash flow that they generate combined with the technical momentum that the stock chart has been showing, and I'll show you that stock chart in a moment, it was worth buying again. Should they continue to generate $3.5 to $4 billion in free cash flow, I don't see the stock as expensive at around $48 billion in enterprise value here. The dividend yield is now over 6% as well. And if the market shifts more towards defensive stocks, I like the idea of having this one in my portfolio. They also recently announced a partnership with Disney, and Kraft Heinz products will be featured in North American Disney parks, resorts, and cruise lines. Kraft Heinz will also have the right to use Disney characters in their products. For a quick look at the technical momentum, here's the chart. The stock is above major moving averages on the daily chart. As you can see here, it's above the 50-day, the 200-day, and the 100-day. There was a crossover of the 50-day and the 200-day. On the weekly chart, the final boss here seems to be the 200-week moving average, but we did have a crossover a while back of the 9 and 21-week EMAs. So I am liking the momentum on this chart. If it can get above the 200-week, I think it could go even higher. As you can see, I am currently in the green here on this one. The next stock I bought was Amazon. I see Amazon as perhaps the most durable Mag 7 stock. As a shareholder, I like the moat that they have from their physical infrastructure and the internet's reliance on AWS. I didn't see the stock as egregiously expensive, and I like the chart well enough. And honestly, I think I just wanted to own this one, especially with, like I said, is the valuation I didn't think was egregiously expensive. I'm glad I decided to buy before the earnings report last week because that's paid off. And as you can see, I'm up over 9% in all accounts so far. By the way, if you were wondering what was this reduce and this realized gain here on Amazon, that was a small, tiny amount of a gain here. Basically, I think what I was trying to do is get the position size and the cost basis in a little bit more favorable way. And so that was just me moving the position around a little bit there. The next stock on the list is one where I actually reduced our position size, and that's Crocs. The free cash flow yield is still pretty high on this one, and they buy back a lot of stock, but I just didn't think there was enough growth to continue to hold an overweight position after it ran into the 130s. It also filled a gap to the upside, and the chart was starting to look tired, being overbought on the weekly chart. And so I made the decision about a week and a half, I think, before the earnings report to take some profits on it because I didn't think that, I just thought that I had too much of it for the upside from that point. So the realized gains on this were 29.2%, and the shares I still hold are up 71.82%. The next stock on my list here is Toast, ticker symbol TOST. This was a new buy. This is a company that sells hardware and software that is geared towards restaurants. Toast is a company that's expected to grow revenue 20% this year and 18% next year, and yet I was able to buy the stock for around 3 times sales. They also have net cash on their balance sheet. I could see Toast products grow to become the iPhone of restaurants, to be honest. Once a restaurant is invested in Toast hardware and software, they become integrated in such a way where I think the products will be sticky, and Toast could just become the standard for restaurants in general. Their market, it's primarily for small and medium-sized restaurant businesses, but they're making a push for more adoption with major chains as well. The chart for Toast is showing momentum with a recent crossover of the 9 and 21-week EMAs. It's above the 50 and the 200-week moving averages, and it's also above the 200-day, 100-day, and 50-day moving averages. It's got a chart structure here where it resembles a bottoming pattern similar to an inverse head and shoulders pattern, I think, on the daily time frame here. And I think that the long-term potential for this one is good, and I'd consider adding to it if it did take a downturn. because I'm really optimistic in the long-term potential of this business. Finally, the last stock I have to talk about today is Canadian National Railway. This is a business that I want to continue to own, and so I just reduced the position in one of our accounts. I think the position had grown to be about 5.8% of that particular account, and I think I reduced it to just under 2.5% of that account. I reduced the position because the chart is looking tired, and while railroads have some of the widest moats you'll find, I do think the valuation is not as attractive as it used to be relative to future growth. Essentially, I'd expect mid to high single digit growth in a business like this. And so I think about 23 times earnings is a bit too expensive to hold the position as big as the one that I had in this account. It did get above these prior highs, so perhaps it does break out higher to the upside, but I just didn't, from a technical and valuation standpoint, think that I should continue to hold as much of the stock with all of these factors in mind, but it is a business I wanted to continue to own. Similar to Crocs, I sold shares with a higher cost basis, so I realized over 15.5% in gains on this sale of the stock, but the shares that I still have are up more than that as of Friday's close. Thanks so much for watching. If you'd like me to do a video on any of the specific companies that I mentioned in this video, let me know in the comments below. Also, if you have an opinion on any of these companies, let me know as well. I'd love to hear what you think. If you got anything out of the video, please like it, subscribe, click the bell to get notifications, and follow me on X at StockSaleFlyer. As always, take care, and I hope to see you in the next one. Bye.